Hello, I'm the Canadian Dividend Investor, and on this channel, we talk finances with the focus on the Canadian and the American stock market. On today's episode, we're going to look at 5 stocks that have earnings this week. So stick around and see what I have. The first company we're going to talk about is Green for Life Environmental, which goes by GFL on the Toronto Stock Exchange and has a market cap of over $12 billion. GFL makes themselves quite visible with their bright green garbage bins and bright green trucks. They're most well known for their solid waste management and liquid waste management. They're located all across Canada as well as 27 states in America, serving over 4 million households. Over the last 12 months, GFL has done quite well as it's up over 68%. However, since November, after it saw a big spike, it has been trading basically sideways and is only up 1%. I was previously in GFL when I bought in last summer, but when there was the big spike at the end of November, I sold out. Green for Life reports their earnings on Monday, and in the first 3 quarters of 2020, they beat their expectations. Year over year, their revenue has continually increased, and while their earnings are in the negative, they've gotten smaller over the last 3 years. They do pay out a dividend, however, you likely won't notice it as the yield is just 0.1%. Which comes in at just 1 cent per share. They did just start paying it last year, so it'll be interesting to see if they do 2 consecutive years to start a dividend streak. Of 9 analysts, 7 state it's a buy and 2 a hold, which gives it a rating of a strong buy. It's currently just over $37 a share, and the analysts give it an average of $40.59 12 months from now. I currently don't own this stock, as I stated before that I sold out in November, but I think this might be a good opportunity. While we take a quick break, I'm going to ask you to hit that like button as it helps the channel grow. And remember, I'm not a financial advisor, so do your own research. And if you want to see more videos, hit that subscribe button with the bell. Now let's get back to the video. The second company we're going to talk about is the Bank of Nova Scotia, which goes by BNS on both the Toronto Stock Exchange and the New York Stock Exchange. It's just shy of $87 billion market cap and pays a good dividend at a 5% yield. Bank of Nova Scotia is one of the 6 major banks in Canada. It serves all over North America and half of South America. With assets of $1.6 billion, it has 90,000 employees. I do own 102 stocks of Bank of Nova Scotia in my RESP. It drips quarterly 1 extra share with a little bit left over. It's up 68% over the last 6 months and has seen a steady incline since the end of November. Similar to other banks around the world, Bank of Nova Scotia took a hit in 2020 that saw revenue and earnings down from previous years. However, they still finished in the positive. They also beat expectations in 3 of the 4 2020 quarters. All Canadian banks are known for their great dividends, and Bank of Nova Scotia is no different. They were raising their dividends twice a year for 12 years until the pandemic occurred. They also lost their consecutive dividend increase streak due to the Canadian government putting a stop on Canadian banks increasing their dividend. They currently pay 90 cents per share, which comes in at over 5%. And like I said, I currently own 102 shares, which holds about 11% of my RESP portfolio. So I'm not adding any more into that account. I'm just letting the drips increase it. Of 8 analysts, 2 say it's a sell, 3 a hold, and 3 a buy, which comes in at a hold. The current price of Bank of Nova Scotia is $71.51, and the 12-month outlook puts it in around that price, with the high being $77 and the low being $66.50. The third company we're going to look at is Bank of Montreal, which goes by BMO on both the New York Stock Exchange and the Toronto Stock Exchange. It has a market cap of $65 billion, and their dividend comes in at a 4.2% yield. BMO is one of the 6 major banks in Canada, 4th largest by market capitalization and assets. It hasn't missed a dividend since 1829, which means in 8 years, it'll have 200 years of consecutive dividend payments. I do own 42 shares of BMO in my TFSA account at an average cost of $71.91. Over the last 6 months, BMO has seen their share price increase 34%. It has just recently met what the pre-pandemic highs were And over the last week, when the whole market seemed to go down, BMO was still able to raise their share price by 4.5%. Bank of Montreal reports earnings on Tuesday, and they beat expectations in 3 of the 4 quarters in 2020. Like Bank of Nova Scotia, they saw a bit of a dip in 2020 after 3 straight years of increasing both revenue and earnings. As I stated before, BMO hasn't missed a dividend payment since 1829. They also increased dividends every year since 2012 and were increasing twice a year since 2013 until the government put a stop to dividend increases from banks. BMO did increase their dividend last February, so they had the rest of 2021 to increase it to keep their streak going. Of 9 analysts, 1 has it listed as a sell, 5 a hold, and 3 a buy, which currently comes in as a hold. Currently, the price is just over $101, and the 12-month outlook has an average of $103.62. As I said before, I currently own 42 shares. Right now, I'm just sitting watching, and like analysts say, it's a hold, and I'm holding. The fourth company we're going to talk about is National Bank of Canada. It has a $25 billion market cap and pays a 3.8% yield. Some will tell you that there's 5 major banks in Canada, while others say there's 6, and that 6th is the National Bank of Canada. It has been around since 1859 and has over 420 banks across Canada, with 59% of them being in Quebec. National Bank of Canada was able to match their 2019 revenue in 2020 and saw just a small decline in earnings. They beat expectations in each of the 4 quarters in 2020 and by large margins in the last 2. Of their competing banks, National Bank of Canada pays the lowest dividend. However, they've been the most aggressive at raising their dividend each year, as they've raised it 18% over the last 2 years. Currently, they pay 71 cents per share paid out quarterly. Of 10 analysts, 8 of them have it listed as a hold and 2 as a buy, which comes in as a hold. The average 12-month outlook is $79.44, which would see a $4 raise in the next 12 months. The fifth company we're going to talk about is Royal Bank of Canada, which goes by RY on the Toronto Stock Exchange and the New York Stock Exchange. It has a $156 billion market cap, is the biggest bank and one of the biggest companies in Canada and all of the TSX. It also pays a dividend at just under 4%. RBC, which it's better known for, has 16 million clients and 84,000 employees spread across 49 countries worldwide. It's listed on the Financial Stability Board's list of global's most important banks in the world. Over the last 6 months, RBC is up 12% and just recently met the pre-pandemic highs and is now up just over 1% since the last year's crash. RBC reports earnings on Thursday, and they beat expectations in 3 of the 4 quarters in 2020, including the last 2. Like all the other banks, they saw a small decline in their revenue and earnings, however, finished the year in the positive. RBC currently pays a dividend of $1.08 paid out quarterly per share. They've increased it every year since 2011 and were increasing it twice a year since 2012 until the pandemic occurred. They did raise their dividend last May, so they'll have the rest of 2021 to increase it to keep their consecutive years of dividend increases going. Of 9 analysts, 8 of them have it listed as a buy, with 1 saying a hold, which gives it a strong buy rating. Currently, the price is just under $110, and the 12-month outlook, the average for the 9 analysts is $118, with the highest saying it should finish around $129 in the 12-month outlook. The last company we're going to look at is a Canadian Imperial Bank of Commerce, better known as CIBC, and goes by the ticker CM on both the Toronto and New York Stock Exchange. It has a $51 billion market cap and pays a yield of 5.1%. CIBC has 11 million clients with 40,000 employees spread across Canada, United States, the Caribbean, Asia, and the United Kingdom. They're most well known for their mortgages. CIBC reports earnings on Thursday, and like their bank competitors, they exceeded expectations in all quarters except for the second in 2020 and saw a slight downturn because of COVID on revenue and earnings, but still did well. CIBC was the first bank to rebound after the pandemic. They exceeded their pre-pandemic high already and are up 17% over the last 6 months. CIBC does pay a very good dividend at a 5.1% yield. However, they're increasing it one of the slowest of all the banks at just 27% over the last 5 years. Currently, they pay $1.46 per share, and I do own 75 shares in my RESP account, which pays me $109.50. And now that the share price is at almost $115, it comes in just shy of being able to drip. Of 10 analysts, 4 of them have it listed as a hold, with 6 as a buy, which comes in at a buy rating. The average of the 10 analysts have it finishing at $123.89 in the next 12 months, which at $114 right now should be a good increase when you add in the dividend. Well, there you have it. 6 companies that report their earnings this week, and they're well-known companies in Canada. Like I said, I own 3 of those companies, with 2 of them being in my RESP account, CIBC and Bank of Nova Scotia. They both pay very good dividends that help for a steady increase on my account. Before you leave, hit that like button. While you're at it, if you want to see more videos, hit that subscribe button with the bell. Thanks a lot, and we'll see you at the next video.